Welcome to PhillipCapital's Weekly Market Watch. September and October have traditionally been the worst months for the stock market. As we approach this period, will history repeat itself? We have with us today Ms. Hilary Ho from Phillips Securities Research to share with us her views. So Hilary, we have seen equities rally seamlessly for several months, yet the momentum in economic activities has not picked up as much and as rapidly. Could you share a little on this discrepancy and how it could possibly happen?
We have seen a bull and a bear working simultaneously. We have a stock market that has been pretty bullish and an economy bear. So for nearly 5 months, the Dow and S&P 500 as well as the Nasdaq have been inching higher and higher. So these indexes have gained as much as 50% from the low in March. At the same time, economic numbers continue to be lackluster. So for instance, retail sales declined in July. Unemployment rate remains at historical high, and banks continue to tighten their lending standards. So I think this discrepancy happened because investors have been encouraged that economic numbers are better than expected and are of course less bad than before. This optimism gave a boost to the stock market, and besides that, the stock market typically bottoms out a few months before recessions officially ends.
We mentioned in the beginning that the September and October months have traditionally been the worst months for the stock market. Could you elaborate on this trend and what history can tell us?
Historically, September and October has been the worst months for the stock market. So traditionally, we see negative average monthly returns for both the Dow and the S&P 500 in the month of September. Also in history, October has been the month where stock market experienced some of the worst single-day crashes. For instance, we had the Black Monday in 1929, 1987, and also the most recent one in 2008, where Dow, S&P 500, as well as the Nasdaq Composite Index declined as much as 7% in a single day.
Do you think this trend will hold true?
Okay, so far the market's gains have been pretty spectacular. The S&P 500 is roughly 50% higher than it was on 9th of March. Hence, even if we're not approaching the traditional months, I think it doesn't take a rocket scientist to figure out that the downside risk is much higher today than it was a few months ago. If we look at some data, it also suggests that a correction in the near term is highly probable. With reference to the results of the monthly asset allocation survey done by the American Association of Individual Investors, it showed that the amount of cash allocation in July has been reduced to 25% from the 45% allocation in March. Okay, that signals that there's an excessive amount of optimism among investors, and from a contrarian's perspective, that is actually a cause to be cautious in the near term.
History repeats itself. What do you think investors should do?
Although I think that history is likely to repeat itself, I think there's still some legs to this rally. As such, if you're an aggressive investor who has been lamenting that, you have missed the boat, you might want to take advantage of any pullbacks. Alternatively, for the conservative investors, they can consider taking some profits or diversify into some safer assets such as gold in the interim.
Thank you, Hilary. That's all we have for you today. Tune in next week for more market updates.